In 1969, a drilling platform in the North Sea hit one of the largest offshore oil fields ever discovered. The country that owned the seabed beneath it was Norway, a small, cold, prosperous Scandinavian nation of 4 million people that had spent most of its modern history being quietly unremarkable. What happened next is one of the most consequential economic decisions in history, and almost nobody outside economics has ever heard of it properly explained. Before we get to what Norway did, we need to understand what oil money usually does to a country. The phenomenon has a name: Dutch disease. It was coined after the Netherlands discovered enormous natural gas reserves in the 1960s and watched its economy deteriorate as a result. Here is the mechanism. When a country suddenly receives enormous revenues from a natural resource, it spends that money domestically. That spending drives up prices. Rising prices make domestic goods and services more expensive than imported ones. Manufacturing and agriculture, industries that compete internationally on price, collapse. The country becomes dependent on the resource for all its income. When the resource runs out or the price falls, there is nothing left. The pattern repeats across virtually every major oil discovery in history. Venezuela nationalized its oil industry in 1976, spent the revenues on subsidies and social programs, allowed no institutional savings discipline, and by the 2010s was experiencing hyperinflation and economic collapse despite sitting on the world's largest proven oil reserves. Nigeria earned over $1 trillion from oil between 1970 and 2015 and ended the period with 70% of its population living below the poverty line. The resource curse is not a myth. It is a well-documented, repeatedly observed economic pathology. Norway knew about Dutch disease. Their economists had studied it. And when the oil money began arriving in the 1970s and 1980s, the political pressure to spend it was enormous. Oil revenues could build hospitals, cut taxes, raise pensions, fund schools. The temptation to do all of those things immediately was, and remains, the trap that destroys resource-rich countries. Norway made 3 decisions that set it apart from every other oil economy on Earth. The first decision was structural isolation. Every krona of government petroleum revenue was to be transferred into a separate fund, initially called the Government Petroleum Fund, established in 1990 and kept entirely separate from the domestic economy. The government could not spend oil money inside Norway. It could only spend returns generated by investing that money abroad. The wall between the oil wealth and the Norwegian economy was not a suggestion. It was a law. The logic was precise and almost counterintuitive. By investing abroad, Norway exported its oil wealth out of the domestic economy before it could cause inflation. Norwegian oil money buying shares in Apple, Microsoft, Nestle, and Samsung in New York, Zurich, and Tokyo does not bid up the price of Norwegian housing or Norwegian labor. It sits offshore, compounding, invisible to the domestic price system. Dutch disease requires the money to enter the domestic economy. Norway prevented it from doing so. The second decision was the fiscal rule. When the fund began generating investment returns, the government faced a new temptation to spend those returns freely. The response was a rule established in 2001 that limited annual government spending from the fund to approximately 3% of its total value, calibrated to match the fund's estimated long-term real return. Spend only the return, never touch the principal. The rule was not always popular. During recessions, during the 2008 financial crisis, during the COVID pandemic, there were arguments for spending more. The rule held. It was breached modestly during COVID, and the breach was clawed back. The discipline was institutional, not personal. It did not depend on any individual politician being virtuous. It was encoded. The third decision was where to invest. The fund was prohibited from investing in Norwegian companies, a deliberate choice to prevent the government from becoming a controlling shareholder in its own domestic economy, which would distort markets and create conflicts of interest. Instead, the fund invested globally in equities, fixed income bonds, unlisted real estate, and more recently renewable energy infrastructure. By 2026, the fund holds stakes in approximately 7,200 companies across 60 countries. It owns roughly 1.5% of every publicly listed company on Earth. If you own shares in any large publicly traded company anywhere in the world, there is a high probability that Norway's oil fund is your co-shareholder. Then there is the dimension of the fund that is most unusual and least discussed: its ethical mandates. The government pension fund Global operates under a formal ethical framework enforced by an independent council on ethics that can recommend, and has exercised the power to exclude companies from the fund's portfolio on ethical grounds. Coal companies, weapons manufacturers, companies linked to corruption, human rights violations, severe environmental damage, or tobacco production. Since the ethical framework was introduced, over 170 companies have been excluded. In 2025, the fund sold its stake in Caterpillar over allegations related to Israel. The fund's ethical constraints are binding, published, and enforceable, and they sit alongside one of the most aggressive return mandates in institutional finance. The result is a fund that is simultaneously the world's most powerful institutional investor and one of the most publicly accountable. So what does $2.2 trillion actually look like? The fund earned $248 billion in a single year in 2025, more than the entire GDP of Portugal. Its market value is more than double Norway's annual GDP. Each Norwegian citizen effectively has a $364,000 claim on the fund's assets. That number requires a caveat. Nobody can withdraw it. It is a claim on a collective national asset, not a bank balance. But it represents something real, the conversion of a finite, depleting natural resource into a permanent, compounding, global endowment that will generate returns long after the last barrel of North Sea oil has been extracted. The lesson Norway teaches is not that oil wealth is good. It is that oil wealth is neutral. It is an amplifier of whatever institutional quality already exists in a country. Norway was already well-governed, already transparent, already possessed of strong democratic institutions before the oil arrived. The fund did not make Norway functional. Norway's existing functionality made the fund possible. Countries that discovered oil without those institutions found that the money made their existing problems worse, not better. That is perhaps the most uncomfortable part of the Norway story. The three decisions: isolate the revenue, constrain the spending, invest abroad, are not technically difficult. They are politically difficult. They require a government to tell its citizens that the money is there, but you cannot have it yet. That the wealth belongs to future generations as much as the present one. That short-term restraint is worth long-term security. Most governments, under most electoral pressures, cannot sustain that argument for the decades required to build what Norway built. Norway did. And the result is a $2.2 trillion fund that owns a piece of almost every major company on the planet, funded by a resource that is already declining, managed by a country of 5.5 million people, and structured to last indefinitely. It is the most successful sovereign wealth fund in history. And it began with a decision in 1990 to say no to spending money that was already there. Welcome to ExpertiseDive. Drop your thoughts below, and if you want us to cover another country's economic story, name it in the comments.